Hey everyone, welcome back for another deep dive. Today we're cracking open The Warren Buffett Way by Robert G. Hagstrom.
Oh, a classic.
Yeah, we're going to try to decode how Warren Buffett picks winning stocks.
Well, more than just picking stocks.
Yeah, I mean, obviously we're not saying just copy everything he does.
Right. Nobody can be Warren Buffett except Warren Buffett.
Exactly. It's more about understanding his philosophy, like how he thinks about value investing.
You know, his approach has stood the test of time. Decades of success. There's a lot we can learn from it.
So let's jump right in. What's the core idea?
Well, Buffett's central idea, as Hagstrom puts it, is to invest in wonderful businesses at fair prices.
Okay, wonderful businesses and fair prices sounds simple enough.
But it's actually pretty profound when you think about it. It's a long-term perspective. It's not about trying to get rich quick.
Yeah, because a lot of Wall Street, it's like, what can you make me today, tomorrow, next week?
Right, exactly. It's all about short-term gains.
Yeah.
Buffett's playing a different game. He's looking for companies he can hold for years. Decades even.
Decades even. Companies that will steadily generate wealth over time.
So how do you determine what makes a business wonderful in Buffett's eyes?
Well, Hagstrom outlines a few key factors that Buffett considers. It's about understanding the business itself, the management team, the financials, and of course the value.
Okay, so it's not just about looking at a stock price. It's about really understanding the company as a whole.
Absolutely. It's about seeing the bigger picture. So let's break it down a little. First, the business itself.
Yeah, what does he look for in a business?
He wants businesses he understands. Companies with a consistent operating history, favorable long-term prospects, and, predictable earnings.
So not like super risky startups or anything.
Not necessarily. He avoids businesses he doesn't feel confident predicting, even if they're trendy.
That's interesting. So it's not just about finding a good business. It's about finding a business you can actually understand and wrap your head around.
Exactly. You need to be able to see where the company's going and how it's going to get there. So that's the business side. Then there's management.
Okay, how important are the people running the show?
Oh, incredibly important. He looks for honest and competent managers, shareholder-oriented, people who are focused on creating value for the owners.
So it's not just about looking at the numbers. It's about understanding the people behind the numbers.
It's about the integrity and the vision of the leadership. And then, of course, there's the financials.
Yeah, what does he look for when he's digging into a company's financials?
Strong return on equity, manageable debt levels, healthy cash flow. He's making sure the company's generating strong returns and using its resources wisely.
So it's like a doctor checking a patient's vitals.
Exactly. You got to make sure the company has a solid financial foundation if it's going to succeed in the long run.
Okay, so we've got the business, the management, the financials. What about the value part? Like, how does he actually figure out what a business is worth?
Well, that's where it gets really interesting. He uses a method called the dividend discount model to calculate a company's intrinsic value.
Dividend discount model. Sounds complicated.
It's not as scary as it sounds. Imagine you had a crystal ball that could show you all the future profits a company will make.
Okay, yeah.
This model basically helps you translate those future earnings into a present-day value.
So it's all about predicting the future.
Well, that's where Buffett's focus on predictable businesses comes in. Remember, he favors companies like, well, back then, Coca-Cola or Gillette established brands with steady earnings, easier to forecast.
Right, makes sense. So you take those predicted future earnings, but what else factors in?
Well, you have to account for the fact that money today is worth more than money in the future. You could invest it now and earn a return, right?
Yeah, of course.
So use a discount rate to bring those future earnings back to their present value.
Okay, I'm following so far. So he projects future earnings, discounts them back to today's value, and that gives him...
The intrinsic value. That's right.
So that's how he figures out what a business is truly worth at its core.
Exactly. But it's not the whole story. Determining intrinsic value is just one part. The next crucial step is...
Buying at the right price.
Bingo. You're catching on.
Yeah.
That's where the margin of safety comes in. It's Buffett's way of protecting himself from, well, the market's unpredictability. I mean, nobody has a perfect crystal ball, right?
Right, so it's like a buffer, a cushion against potential errors in his calculations.
Exactly. He looks for a discount, a good discount between that intrinsic value he's figured out and the market price of the stock.
The bigger the discount, the better.
The bigger the discount, the larger his margin of safety, the lower his risk.
So it's like buying $1 for 50 cents, basically.
That's a great way to put it. And Hagstrom gives some great examples of how Buffett put these principles into action. Like, remember Coca-Cola?
Oh, yeah, classic Buffett. Everyone knows that one. What made it so attractive to him back then?
Well, it was already a global giant in 1988, but Buffett saw a company with incredible consistent earnings, strong brand, great leadership under Roberto Goizueta.
Sounds like a winner already. But how did he actually figure out its value?
He used, well, you guessed it, the two-stage discount model. He recognized Coke's growth rate wouldn't stay sky high forever.
So he built in a slowdown at some point.
Exactly. He figured Coke could grow earnings maybe 15% a year for 10 years, then settle at a more moderate 5%, then discounted those projected earnings back to 1988 using the risk-free rate, and boom.
He arrived at an intrinsic value higher than what the market was saying.
Much higher. So even though Coke was doing well, he saw it as undervalued. He saw that huge margin of safety, that chance to buy a dollar for much less.
No wonder he went big on that one. Did Hagstrom talk about any other companies, other examples?
Of course. Gillette is another classic. Strong brand, consistent earnings, great management.
Sounds familiar.
Used the same two-stage discount model. Built in that high growth period, then a more moderate pace. And again, found that margin of safety, buying below his calculated value.
So it wasn't just about buying great companies. It was about buying them at a great price. That's a key point, right?
Absolutely. You can have a fantastic business, but if you overpay, you're not going to get those Buffett-like returns.
Makes sense. Now, Hagstrom also talked about some less obvious picks, right? Like
Yeah.
the Washington Post company, not exactly a tech startup.
Right. But this one shows how Buffett finds value, even in industries that might not seem exciting on the surface, like newspapers in the 70s. What did he see there?
What did he see?
Their unique pricing power. They could raise prices above inflation, especially local ones with less competition. Plus, he liked the leadership, Katharine Graham, committed to profitability.
So it wasn't just about the industry. It was about the specifics of the business and the people at the helm.
Precisely. He dug deeper, looked beyond the headlines, so to speak, calculated intrinsic value using their net income, the risk-free rate, their pricing power, and, wouldn't you know it, trading at a discount to his estimate.
Sensing a pattern here, find a great business, calculate its value, buy it on sale.
You got it. One more example just to solidify this, Wells Fargo. Buffett invested in them during a tough time for banks.
Oh, yeah, banks can be tricky, lots of risks involved, loan losses and all that.
Right. But this shows how Buffett thinks about risk. He didn't ignore it, but he saw Wells Fargo's strengths too. Good loan portfolio, strong leadership with Carl Reichardt, history of solid returns.
So he was weighing the risks against the potential rewards.
Exactly. He looked at the threats like earthquakes, financial panics, a real estate slump. He assessed how likely they were.
That's some serious risk management.
And even after factoring in potential losses, he figured Wells Fargo was still a bargain. He was right. The bank recovered, the stock soared. Berkshire made a ton.
So we see the same threat, from Coke to razors, newspapers to banks. It's about understanding the business, the management, the financials, and buying at the right price.
Absolutely. And Hagstrom lays out these principles really clearly. He calls them Buffett's investment tenets, which we can kind of group into 4 areas: business, management, financials, and value.
Okay, I like this, breaking it down into those 4 areas. So first up, those business tenets. What does he really look for in a company besides what we've already talked about?
Consistent operating history, favorable long-term prospects. He wants to see that steady track record, be able to project where the company's headed.
No big surprises there. It's about stability and predictability. What about the management tenets? How much weight does he put on the people running the show?
Oh, a huge amount. It's one of his biggest focuses. He wants managers who are honest, competent, and really shareholder-oriented, looking out for the owners of the business.
So it's about more than just their track record. It's about their integrity and vision, too. What about the financial tenets? What kind of metrics is he looking at?
Return on equity, debt levels, cash flow. He wants to see a healthy financial picture, a company that's using its resources well and generating strong returns.
Like you said before, got to check those vital signs.
Exactly. And finally, we come to those value tenets. This is where he pulls it all together.
This is where the rubber meets the road.
You got it. He figures out the intrinsic value, like we talked about, with the discount model. But remember, it's not enough just to know the value. He waits for the right price, looking for that margin of safety.
Buying that dollar for 50 cents.
Exactly. So it's really a holistic approach, looking at the business, the management, the financials, and then putting it all together to assess the value.
It's about seeing the whole picture, the long-term potential.
Exactly. And these tenets, they all work together They guide Buffett toward those smart decisions he's known for. Of course, this is just the tip of the iceberg. There's so much more to explore in Hagstrom's book.
Yeah, we're giving our listeners a glimpse into Buffett's brain. But it's up to each individual to do their own research.
Absolutely. No substitute for thorough research and analysis.
Speaking of digging deeper, Hagstrom brings up a fascinating concept, Buffett's circle of competence.
Ah, yes, a crucial part of his approach.
Basically, he avoids businesses he doesn't understand, even if they're hot and everyone else is jumping in.
He famously missed out on the early tech boom because of this. He just didn't feel confident in predicting its future.
That's pretty amazing. To resist the temptation to chase the latest trend, it shows real discipline.
And it highlights the importance of self-awareness. As an investor, you need to know your limits, what you understand well and what you don't.
So that's a great place to wrap up this first part of our deep dive. We've covered a lot of ground, but there's still so much more to uncover in the Warren Buffett way.
Absolutely. We've just scratched the surface, and next time we'll delve deeper into this idea of the circle of competence and how you can apply it to your own investing journey.
Stay tuned, folks. There's much more Buffett wisdom to come.
And hopefully some inspiration for all you deep divers out there.
Exactly. We'll be right back after a short break. Welcome back, everyone. We're continuing our deep dive into the Warren Buffett way, and I'm really intrigued by this idea of the circle of competence that we touched on before the break.
Yeah, it's a crucial concept. It's almost like Buffett saying, know thyself before you even think about buying a stock.
Right, like understand your strengths, your limitations as an investor.
Exactly. Hagstrom really drives this point home with how Buffett just steers clear of those industries he doesn't fully grasp, even if they're booming. Like, he missed out on that whole early tech boom.
Because he didn't get it.
Yeah, not because he thought technology was bad or anything, but because he couldn't confidently predict its future. He was okay with that.
That's remarkable. I mean, most people would be kicking themselves, right? Missing out on those early tech gains. But Buffett seems content with sticking to what he knows, even if it means leaving some potential profits on the table.
It's a powerful lesson for all investors, for sure. You know, it's so easy to get caught up in the hype, to chase the latest hot stock or industry. But as Hagstrom illustrates, Buffett's success comes from his discipline. That focus on what he understands deeply. He doesn't try to be an expert in everything.
He sticks to his knitting.
Exactly.
So, for everyone listening, the question becomes, what's your circle of competence? Where do you have an edge that others might not? What do you know really well?
Right. Think about it. Maybe it's an industry you've worked in, a hobby you're passionate about, or a type of business model you find fascinating and easy to understand.
Like, I know someone who's obsessed with sneakers. They could probably tell you everything about the shoe industry.
Exactly. Or maybe you're great at analyzing consumer trends, or you have a deep understanding of healthcare, or you're a master at those financial statements, really dissecting them.
It's about using what you already know, your experience, to your advantage in the market.
It's about becoming a master of your niche.
Not trying to be a jack of all trades.
Right, that's where your real investment power lies.
It's kind of like if you were starting a business, you'd probably choose an area where you already have some expertise, right? It makes sense to do the same with investing. Play in a field where you know the rules of the game.
Such a good analogy. And it's really freeing, isn't it? It means you don't have to invest in everything, chase every hot trend, or feel like you need to understand every single industry out there. You can just focus your energy, become an expert in your chosen domain.
Become that go-to person for, like, I don't know, sustainable energy or something.
Exactly. And then as you dig deeper into that circle, remember all those other tenets we talked about, understanding the business, the management, the financials, and ultimately the intrinsic value. Those are essential no matter what industry you're looking at.
So it's about combining what you know best with those sound investment principles that Buffett uses. It's about being a thoughtful investor, making decisions based on a deep understanding of the business and yourself.
And don't forget, Hagstrom makes it clear that learning is an ongoing process, right? It never really stops. The market's always changing. New industries pop up. Existing ones transform.
So you got to stay flexible.
Yeah. Stay curious, keep learning, and be open to refining your circle over time.
So it's not like you pick an area and you're stuck with it forever.
Right. It can evolve as you do.
Well said. Now, we could probably talk about the Warren Buffett way for hours, but we do need to start wrapping things up.
Yeah. Time flies when you're having fun.
Before we go, though, I want to leave our listeners with one final thought.
Okay, shoot.
Investing, it's not just about picking stocks, right? It's about understanding businesses, yes. But it's also about understanding yourself, your strengths, your limitations, even your biases. It's about becoming that discerning investor who makes smart choices based on a deep understanding of both the business and what you bring to the table.
Beautifully put. And on that note, we'll wrap up this deep dive. We hope you've all enjoyed exploring the Warren Buffett way with us.
Maybe sparked some new ideas, maybe gave you a new perspective on your own investment journey.
And remember, everyone, embrace that journey. May your portfolios be filled with those wonderful businesses bought at those fair prices.
Happy hunting out there, fellow deep divers. May your circle of competence guide you towards lasting success. You know, it's funny, we've talked about so many different aspects of Buffett's approach, but it really comes down to this. Investing is just as much about self-discovery as it is about analyzing those companies.
It's so true. Hagstrom really paints this picture of the Warren Buffett way as more of a mindset than just a set of hard and fast rules.
Right. And a huge part of that mindset is understanding your own circle of competence, knowing where your knowledge is strongest, where you can really make those informed judgments about a business.
Absolutely. It's about becoming an expert in your own right, leveraging your unique insights, those experiences you bring to the table.
Like maybe you're amazing at spotting those consumer trends, you know? Or maybe you're super familiar with the ins and outs of the healthcare industry. Or maybe you're a master at deciphering those financial statements.
Whatever it is, that's your sweet spot.
That's where your power lies as an investor.
And don't be afraid to let that circle evolve. As you learn, as industries change, your areas of expertise might shift too.
Makes sense. It's not like you pick one area and you're stuck with it forever.
Right. The key is to stay curious, keep learning, and just be honest with yourself about where your true understanding is.
This whole deep dive into Buffett's world has been so eye-opening. It's not about like blindly copying his stock picks or anything.
Oh, definitely not.
It's about really absorbing that underlying philosophy, understanding those businesses, valuing them correctly, managing that risk, and crucially, knowing yourself as an investor.
Couldn't have said it better myself. Hagstrom's book, it doesn't just give us a playbook. It gives us a framework for thinking about investing in a way that's both disciplined and adaptable.
I like that, disciplined and adaptable.
Yeah, it's about combining those sound principles with your own unique strengths. So to everyone listening out there, as you go on your own investment journey, remember, it's a marathon, not a sprint.
So true.
There will be ups and downs for sure, but with patience, with discipline, and that commitment to lifelong learning, you can navigate those bumps in the road and build a portfolio that really reflects your knowledge and your goals.
And don't underestimate the power of really knowing yourself, your strengths, your limitations, your biases even.
It's all part of it.
It's about becoming that smart, discerning investor who makes informed decisions, decisions based on a deep understanding of both the business and your own capabilities.
Well said.
We've covered so much ground today, but I think the core message of the Warren Buffett way is this. Successful investing, it's a blend of knowledge, discipline, and self-awareness. It's about finding those wonderful businesses at those fair prices.
But also about finding your own unique path, your own way in the market.
Exactly. And with that, we'll wrap up this deep dive. We hope it's been an insightful journey for all of you. Maybe sparked some new ideas, maybe gave you a fresh perspective on your own investing.
Happy hunting out there, everyone. May your portfolios flourish.
And may your circle of competence guide you toward lasting success.